Hello everyone, welcome back to another financial market class, and today I'll be introducing us to what financial market is, their types, and how to choose the best investment suitable for you. Just for introduction's sake, my name is Timile Shonoga, aka Virtuous One, and by profession I'm a financial advisor in Yes Insurance Group. So basically I deal with fixed deposits. So if you want to fix your money for some period of time and earn interest, just be sure that I'm your go-to-go girl. So without much ado, let's go into the teaching of the day. Now we are talking about financial markets. First, what are financial markets? Financial markets are places, whether physical or digital, where buyers and sellers trade financial assets, and we can also call these financial assets securities, and we have them in form of stock, bonds, currencies, and derivatives. And I believe when we talk about stock, you know what we mean, right? So basically, stock is about buying of shares in companies, and when you buy shares in those companies, you own a part of the company. You know that, right? And bonds is like loaning federal government or large companies certain amounts of money, usually for a long period of time, and you get probably annual interest on your money, and at the end of the time you get your capital. You understand? And we also have currencies. We have currencies in form of dollars, euro, Nigerian naira, which people trade in financial markets. And lastly, we have derivatives. We have people who trade gold. So you can buy gold, keep it in the house with the hope that probably in 2 months time, in 3 months time, the value would have increased, and probably you buy it at the rate of $2,200. You might be able to sell it at the rate of $2,500. You know, it has appreciated. So that's just what financial markets mean in simple time. And one thing about financial markets is that it helps people to move money from people or institutions with extra funds to those who need the funds. And financial market has various importance. It is essential for economic growth, it is essential for investment opportunities and wealth building. So without wasting much of our time, I want us to go into the types of financial markets that we have. And the number one on my list is bond markets. Just like I said the other time, as an investor, when it comes to bond market, you loan federal government or company certain amount of money. And I wrote it here that a 10-year government bond means you lend money for 10 years and earn regular interest, often considered safer than stock. Yes, when it comes to bond, it doesn't really have risk attached to it like stock that can rise and go low. Bond is safer, it has less risk, it is safer. It is like a conservative way of protecting your money. Then why does it matter? Government use bond to fund infrastructure and public spending. Bond can also be less volatile than stock for stable income. So if you are looking for ways of earning stable income that won't put your mind, you understand, on the high pitch, that you won't have blood pressure, just in case you are not a high risk taker, you might want to consider bond. Then I also have foreign exchange markets on my list here. I believe you are familiar with the term forex. Now, it is where currencies are bought and sold, and like I said, we have currencies in form of dollar, Nigerian naira, euro, pounds, anyone. We have a lot of them. Then forex market influences import and export prices. It also influences inflation and investor confidence. Forex markets determine exchange rates, like how many naira equals $1. How many naira equals 1 euro? That's basically what forex market is all about. Then we have money markets. Money markets are for short-term borrowing or lending, usually less than 1 year. And we also have the ones that are for 1 year, like treasury bill. You can invest in treasury bill for the period of 3 months, 6 months, 1 year, and claim your money. And they don't have high risk compared to some other ones that you may want to consider, and they also yield well. Sometimes it can be on 11%, sometimes 12%, 18%, 16%, as depending on how the market is. So, and it is safer and liquidable. It's good for preserving your capital and any short-term returns. Then we have capital markets. Capital markets include both the stock market, commercial paper, and bond market. Basically, market for long-term money. That's what we know capital market as, usually for more than 1 year. Now, let me give you these statistics. In 2025 alone, NGX supported approximately 6.49 trillion in capital raising across equities and debts, showing how markets help fund real economic activity. Then we also have derivative markets. Derivatives are contracts whose value depends on the performance of another asset, like stock, bond, and commodity. Sometimes, I told you the other time, you can buy gold, you understand, with the hope that it will rise in price in maybe 3 months' time. So when you buy it and it rises from maybe $2,200 that you bought it to like $2,500 or $2,300, you consider that you gain, right? But if it doesn't rise, it goes low, then you consider that you lose. So, but that's just one aspect to it. Now let's quickly go to stock. I believe this is the reason why many of us are here presently. Well, stocks is where shares of companies are being bought and sold. And when you buy shares, you own a part of the companies. So if you have been wondering, you're of certain age, you are not yet a CEO, you don't own a company for yourself, my advice for you is to buy shares in as many as possible companies. So let's say you buy shares in 5 companies. You have a say in 5 companies, my dear. You buy in 10 companies, you have a say in 10 companies. So shares is like owning a part of a company. Public sectors are listed on NGS, and you can buy their shares by units. You can decide to buy 1 unit, 10 units, 50 units, 100 units, and as you are buying those things, you are also having a say in the company. And one thing about shares is that when the company is gaining, you are gaining. But when they are losing, you know that you are also losing. Let me also give you this statistic. The Nigerian Exchange Group, NGX, reached historic highs in early 2026 with capitalization above 100 trillion naira and broad gain across sectors. In 2025, the NGX All-Share Index delivered strong returns, one of the best performances in about 20 years. Now let's talk about the types of stocks and their categorization on NGX. Now the first on my list is growth stocks. Well, let me say these companies are just coming up. They are companies that are just coming up, and they are mostly technology-driven companies. Now the second on my list is value stock. These are shares from strong companies that are temporarily cheap. They are strong companies like UBA, Dangote, Sugar, but their shares are temporarily cheap, and they are good products. I call them good products on discounts. Why their value stock becomes cheap is because of economic downturn, sometimes market overreaction, negative news, and lots more. So value stocks are also strong companies. Then another one on my list is dividend stock. These are the kind of stocks that they regularly share their profits. So we have them like Access, MTN, Seplat, Zenith, Presco, and so on. These stocks, they share dividends. Aside your normal profits, you might be getting extra dividends. Then the next one on my list is blue chips stocks. You see, these ones, they are large, they are trusted companies, they are financially strong, and they are stable. They have survived every economic crisis, policy changes, market crashes, and lots more. These ones, they are reliable. Let me say they are reliable. And we have examples like Dangote Cement, GTCO, Nesu, and lots more. So we call this kind of stocks market leaders. They are leading the market. And the next one on my list is sector specific stocks. When we talk about banking sectors, consumer goods, tech, pharmaceutical, oil and gas, insurance, so those are classified under sector specific stocks. Now the last on my list is penny stocks. These are the kind of shares that are traded at very low prices, often 1 naira, 5 naira. In fact, I've seen one of 0 point something naira. I was like, hey. But one thing about these shares is that you have to be very, very careful because they have low liquidity and they have weak financials. This kind of shares can go high and at the same time, in the twinkling of an eye, go low. So they have high risk. And these are the kind of companies, the companies classified under this kind of stocks. We call them small or distressed company. They have poor corporate governance. So you have to be very careful when you are picking penny stocks. If you are not a high risk taker, it is not even advisable at all. But if you are a high risk taker, well, you can try it, but then be careful. Know the kind of person that you are, because as much as it has many disadvantages, it also has some advantages. Like, it's a cheap enterprise. Imagine you have just 1,000 naira and you are buying like 1,000 units of a share or 700 units of a share, and your mind will be like, wow, I have a lot of units, but it's just 1,000 naira that you used in buying. They are cheap enterprise, and like I said, it has possible high returns. It can go high, but at the same time, it can go low. Your 1 million naira can become 2 million naira, and it can also become 0 naira or 500,000, or whichever the case might be. So that's one thing about penny stocks. So let me give you a few examples. There are companies like Totalizer. We have FTN, Jais Bank, FTN Cocoa, Jais Bank, and lots of them like that. You always see them at cheap price. You understand? They are different from value stock. Value stock are also a bit cheap. You'll be seeing them at the rate of 30, 40 naira, 50 naira. You understand? You know, you can still purchase many units with that. With 5,000, you can still purchase like hundreds of some value stocks, but they are still a bit more, let me say, the companies are still a bit stronger than the companies under penny stocks. I believe that is clear enough. Now let's quickly talk about how to choose your investments. Now, before you choose investments, you have to ask yourself some 4 important questions. The first one is, do I want fast growth or steady income? See, if you want steady income, just consider fixed deposits, consider treasury bills, consider bond. But if you want fast growth, you might consider stock. So you have to understand your plan and whatever you want to achieve before picking your investment. Then the second question you might have to ask yourself is that, how much risk can I tolerate? You have to understand your risk tolerance level. If you are not a high risk taker, please, you can avoid some stocks as much as possible. But if you can take risk, you can try stock out. You know, sometimes we need to stick our head out of our neck, you understand, before we can achieve some great things as well. And the third question you need to ask yourself is that, am I investing short term or long term? You need to tick this box too before you actually invest. Then the last question on my list is, do I understand the industry? Understand the industry, most especially when it comes to stock. You have to understand before you invest. You need to understand some analysis. We have different type of analysis when it comes to stock markets. We have fundamental analysis, we have technical analysis, and we have sentiment analysis. When it comes to fundamental analysis, you want to answer the question, is this company worth investing in? You need to check that. Check their revenue and profits. Check their earning per share. Check their price to earning ratio. Check their debt level, their management quality, their industry position, economic condition. Please check the company very well. Make inquiry. Do your research on a company before you invest your money in their shares. I beg you. Now, when it comes to technical analysis, it goes deeper. That's when you will know when you should buy and sell. You must know when to buy a share, and the fact that a company is stable and it has a high growth level doesn't mean that you can buy at any time. You must know when to buy, and it is always advisable to buy when it is low and sell when it is high. Be sure that check their year to date, check their value, check a lot of things. Be sure that you are buying at a low price, so that you will not buy at high price and at the end of the day start selling at low price. Then we also have sentiment analysis. Yes, you have to understand the investors. How are the investors feeling? The people investing in those companies, how are they feeling? The news on social media, the investor behavior, market momentum, fear and greed index. You have to understand all of these things before you pick your investment. And I believe with all this, we've been able to catch one or two things from it. In our next in the next video, you'll be learning more. You'll be learning about some technical terms you need to understand, how to build a healthy portfolio. You'll be learning how to diversify and the reason for diversification. So thank you very much.